Today, in under 20 minutes, I will provide what you need to know if you want to invest in Celsius. Trading near $45 per share, I currently have a buy rating on Celsius, but there are several key factors that have a major impact on this thesis that I'll go deeper on. I will give you the positives and negatives from the 3Q25 results, a breakdown of the three financial statements on my Wall Street valuation model, what other analysts on Wall Street say about Celsius, and my conclusion on the future of Celsius and what you should do. So why should you listen to me? My name is Ken Freeman. I'm a CFA charter holder. I'm also a professor of finance and economics. I have 20 years of Wall Street experience, and I'm the guy that investment banks like JP Morgan and asset managers like BlackRock hire to train their financial analysts on Wall Street. In my research, I discovered 7 things that got me very excited and 6 red flags to watch out for with Celsius. If you're enjoying this, please smash that like button. Celsius beat on revenues and earnings in 3Q25, but the stock fell because growth was driven more by the acquisition of Alani Nu than the organic growth of Celsius.
Any news?
Let's cover the red flags first. Celsius admits that distributor inventory is still lower than usual, even after a rebound. That means that stores aren't stocking as much product, a quiet sign that demand may not be keeping up.
But the shares are down over 20% as investors worry that the transition to PepsiCo's distribution network could disrupt sales.
Celsius stock dropped 30% in just 2 days. While profit taking is expected, a big drop in a couple of days means that some investors don't buy the story.
No bueno.
While other brands like Alani Nu soared, the core Celsius brand market share slipped slightly. This is what was cited as a reason for the stock getting hammered. While gross margins have expanded over the last year, management still cited tariff headwinds. Management has done a great job managing costs thus far, but they need to hold the line moving forward.
Definitely headwinds within tariffs. That's one thing we're working on with our suppliers, making strategic purchase decisions. We do see within the category is seeing double-digit growth. Back to double-digit growth, our portfolio is aligned with those health and wellness trends that consumers are looking for. We're working on a variety of strategies to continue to maintain margin.
Celsius borrowed up to $900 million to fund the acquisition of Alani Nu and drew the full amount immediately, going from no debt at the beginning of the year to almost $1 billion while integrating 2 acquisitions is a tall order. A major shareholder dumped $2.5 million of Celsius stock recently. After a 118% run-up of the stock since the end of last year, hedge funds reduced positions by 43% in 3Q25. The question is whether these sales amount to profit-taking or skepticism in the growth story.
And another investor sale, this time for Celsius, unloading 40,000 shares for $2.5 million. That investor trimming their position by 15%.
Here's what got me really excited. Rockstar officially joined the Celsius portfolio in August. Not only is Celsius the #3 energy drink brand, it is also increasing its customer breadth.
Celsius will acquire the Rockstar energy brand in the U.S. and Canada, while PepsiCo will nominate an additional director to serve on the board at Celsius.
The Alani Nu deal opens Celsius to new categories and demographics, specifically Gen Z and women. More products, more people means more potential.
And we have Alani Nu, which is one of the fastest growing brands in the energy category, bringing in new female consumers, which is a growth driver within the category. What we have with this transaction, it brings Alani into the PepsiCo system, really has a uniformed, one of the best distribution networks out there and their capabilities.
Celsius posted $725 million in Q3 '25 revenue, up 173% year over year. That kind of growth puts them in a special class. When you grow this fast, the world notices.
Celsius Holdings topped analyst estimates in its third quarter, revenue surging over 170% from a year ago, primarily driven by its newly acquired Alani Nu brand.
After EBITDA margin fell in 2024, Celsius ran leaner and improved costs every quarter in 2025. Cost control while integrating 2 acquisitions means more money hits the bottom line. Celsius added senior leaders to guide marketing and international growth. Experience turns fast growth into sustainable growth.
So having one united distribution front and all the additional focus within our portfolio within Pepsi, leveraging their sales force, their organization, their merchandising, and also leveraging our infrastructure that we built here at Celsius through our supply chains and operations, driving additional efficiencies. It really is seamless within us, and we're excited about that.
Celsius holds the #3 spot by dollar share, and it has nearly doubled on a percentage basis since acquiring Alani Nu. Being in the top 3 means they're in the big leagues now, not just a niche fitness drink. This is what everyone is missing. They're not just riding the category, they drove over a quarter of the growth. That means the brand is actually moving the shelf, not just copying the trend.
This Coke tastes like Pepsi.
When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's financial statements. Would you buy a house without knowing the size, location, dimensions, or condition? That is exactly what you're doing when you buy a stock without understanding the 3 financial statements. If you want to see how I train the world's top financial analysts on Wall Street, check out my school community Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than the liabilities, equity increases, and we win. Cash is the lifeblood of any business. Celsius has increased its cash by 43% since 2022. This is impressive considering the 1Q25 Alani Nu acquisition used cash of $375 million and the 3Q25 Rockstar North America acquisition used cash of $585 million. As mentioned earlier, Celsius has a big exposure to Pepsi, with close to 70% of accounts receivable coming from Pepsi at year end. But that exposure has been cut nearly in half to 37.4% at the end of 3Q25. And they haven't fully tapped into distributing Alani Nu through Pepsi's distribution network, which opens up an entirely new growth opportunity. With a physical product business like Celsius, we need to monitor operating working capital, which consists of accounts receivable, inventory, and accounts payable. We measure how efficient they are at managing this via the cash conversion cycle, which looks at how fast a company sells its inventory, collects receivables, and pays suppliers. Over the last 4 quarters, Celsius has decreased its cash conversion cycle by over 40%, despite the Alani Nu and Rockstar North America acquisitions, which is incredibly impressive over such a short time period. Retained earnings has increased 2.8x over the last 6 quarters, going from almost $59 million to over $165 million. This is the net income that Celsius reinvests in the company, and considering this was negative in 2023, it shows that the company is on the right track. So what's the takeaway? Despite the Alani Nu and Rockstar North America acquisitions in the last 7 months, Celsius is managing working capital efficiently, retained earnings is positive and growing rapidly, and Celsius is preparing to take over the energy drink market. The income statement shows us if the company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profit is via margin. Revenues minus expenses equals income, income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Revenue has increased 6.8x since 2021, and while Pepsi was nearly 60% of the total in 2023, it's now only 35%. With the addition of Alani Nu and Rockstar combined with Pepsi's distribution, this momentum will continue. Gross profit has grown even faster than revenues at 8.5x, and this is one of the most important metrics for beverage companies. When we look at the margins, they have gone from 40.8% to 51.4%. In addition, Celsius has done a great job managing overhead over the last year, with EBITDA margin going from negative all the way to positive 24.2% in 3Q25. We see that not only is Celsius growing rapidly, but they're also reducing costs at the same time. Net income has grown 27.3x from 2021 to 2024. This is important because this is what drives retained earnings and ensures reinvestment in the business. It is also the primary catalyst for operating cash flow, which we'll see next in the cash flow statement. So what's the takeaway? Revenues growing rapidly, costs are declining, and with the Alani Nu and Rockstar acquisitions, Celsius is set to take on Red Bull and Monster. The cash flow statement tells us where the cash is generated by the company, and there are 3 buckets. Operating, which is the cash the company generates internally, investing, which is the cash demanded for long-term growth, financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash making this positive, not losing cash, which would make this negative. CapEx is the fuel that drives future growth. Since 2022, CapEx has nearly tripled. And with the acquisitions of Alani Nu and Rockstar Energy in 2025, quarterly CapEx has more than doubled. Despite these increases in CapEx, free cash flow has boomed. Free cash flow has increased more than 5x since 2022, driven by the strong net income that Celsius is generating. This is what drives value, which we will see next in our DCF valuation. The Alani Nu acquisition has already been a game changer for Celsius. Celsius has nearly doubled its percentage market share, and that will increase when Alani Nu gets added to the Pepsi distribution network starting December 1st. So what's the takeaway? While the Pepsi partnership has proved to be an incredible move allowing Celsius to grow rapidly, the recent major acquisitions of Alani Nu and Rockstar put Celsius on a new path of growth and expansion. So what do I think about Celsius and what should you do? I'll get into that, but first, let's go through my valuation. On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the 3 financial statements, we can take these future cash flows, discount them back to today to get a current intrinsic value for the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. As you can see on the left, we take specific line items that we projected from the 3 financial statements. We use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get the total enterprise value. To get to equity value, we strip out the debt, we add the cash, we strip out non-controlling interest, we add associate investments. We get an intrinsic equity value of about $19.6 billion. We divide by the current shares outstanding, we get an implied share price of $75.86. Compared to the current close of $44.91, that's a 68.9% discount, which is a screaming buy rating. On Wall Street, if a stock is trading at greater than a 20% discount, it's considered a buy because it provides us a margin of safety. I'll give you my thoughts on how to play Celsius stock later in the video. So what does Wall Street have to say about Celsius? Let's cover that next. Wall Street analysts have a general consensus of strong buy after the 3Q earnings, and while some have lowered their price target, most feel that the stock has been oversold. Bank of America maintained an underweight rating and cut its price target to 50 from 55. They cited demand softness and execution risk that cloud near-term margin visibility. Morgan Stanley has an overweight rating, but cut its price target to 64 from 70. They say that the drop is overdone, pointing to robust category, Celsius retail strength, and Alani runway in the first half of 2026. JP Morgan kept an overweight rating, but reduced its price target to 68 from 76. They framed the post-print weakness as an entry point, with shipment and depletion timing noise, and the Alani Nu transition expected to fade. CapIQ gives me a sense of how other analysts on Wall Street view the company. 21 analysts cover Celsius on Wall Street. The range is from a low of 38, which is a 15% decrease, to a high of 80, which is a 78% increase. The median is 69, which is a 54% increase. The overall rating on a scale of 1 to 5 is 1.73, which is an outperform rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I do own a position in Celsius. It's currently the 10th largest position in my portfolio at a weight of 4.4%. I bought more Celsius after the pullback, and I am very excited about Alani Nu getting distributed in the Pepsi network, and I like the Rockstar acquisition. If you decide to buy Celsius, you need to get in at a good entry point, which I'll reveal shortly. Celsius announced a $300 million stock buyback right after the price drop. With $932 million of cash on hand and the stock trading at a discount, this is a positive sign for investors. Sales in Asia came in more than twice what experts predicted. The brand's starting to catch fire overseas. This is the next wave of growth.
Well, we just started our expansion internationally. Historically, we've mainly been in the Nordics, in Sweden and Finland. Just recently launched in Australia, New Zealand, Ireland, France, and Benelux. So big opportunity for us this year. These global health and wellness trends that we're seeing are not only in the US. These are global trends. Health, wellness, fitness, lifestyle runs through the DNA of all consumers. So the opportunity exists with our great refreshing portfolios.
Pepsi's additional $585 million investment in Celsius signals confidence. Having an investment of over $1 billion in Celsius and an 11.6% ownership stake shows that Pepsi is putting its money where its mouth is.
PepsiCo announcing it will boost its stake in energy drink maker Celsius, increasing its ownership to about 11%.
Celsius recently hit a 52-week high of 66.74 in mid-October 2025, and it's down almost 33% since then. Celsius hit its 52-week low of 21.10 in mid-February, and it's up over 112% since then. Celsius is the number 3 player in the functional beverage space behind Monster and Red Bull, and the Alani Nu acquisition has helped them grow and take market share. My model shows a value of 75.86, which is a 68.9% discount at current levels. On Wall Street, we buy with a margin of safety of at least 20%, so Celsius is a buy at current levels. The Wall Street median of 65.95 suggests buying below 55 for a 20% margin of safety. With only 2 quarters of results, with Alani Nu as part of Celsius, and only 1 month from Rockstar, and the future integration of Alani Nu into the Pepsi distribution network, we should see some exciting results from Celsius over the next few quarters as momentum and international expansion continues. If you like this and want to see another in-depth stock valuation, check out my Chipotle video here or my Tesla video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.